All right, sounds good. Thanks for having me, and everybody that's here. Thanks for being here. I thought what I'd do is share a little bit about the QRP, the qualified retirement plans, and do a little presentation. Then y'all can just ask questions. And if you have questions during the presentation, you can just stop me and I just put them in the chat function or the Q&A thing, and I'll take a pause. Basically, I'm a professional investor, and I have a company that sets up retirement plans, and we're basically putting the nails in the coffin of IRAs. So if anybody has an IRA or thinking about IRA, I'm going to show you why the IRA is the ticking time bomb in the real estate world. So I think it'll be kind of fun, and we'll try to make this entertaining. So let me just grab a screen and let's.
Are you able to get the screen, Damion? I think you should be able to.
Yeah, we're good. I'm just going to go ahead and click share. So you guys should see the PowerPoint right now. And I'm going to, oh, it's because I drug it to a different screen. Let's put it back over here and we'll start it again. You learn new things every day when you have multiple screens. All right, let me go ahead and start it. All right, so just real quickly, can you guys see, I want to make sure that, can you all see the screen that just has my book and my name on it?
Damion, I think we see both. We see your presentation mode.
All right, this is going to be interesting. All right, we're gonna do. It's called fast adaption, which you have to learn how to do in real estate. Things never supposed to. So we're gonna do a little twist on this. And give me one second.
I think you can flip the screen. You can choose which screen you're seeing.
Let me go back over to the settings here. Sorry guys for the delay. We're gonna get this right. All right, so you can see the screen. We're just gonna go through the slides and we'll just go with it, right? You just have to go with whatever's in front of you. All right, so basically I wrote this book on the QRP, and at the end, if you all want a copy of this, I'm happy to give you a copy and mail it out to you, whatever you want. And I'll give you a version of the Cliff Notes if you want to see those as well. And basically what this is all about, it's about breaking financial bondage. That's why I do this, and that's part of probably why you're here, is to have some type of financial shackles removed. And so that's really what this is all about. And we're going to give you a tool that probably many of you have kind of heard of with retirement plans, but you probably haven't heard of this particular piece. So let me just dive into this and tell you why this is important, because of this guy. This is the IRS, and the problem with the IRS is this little three-letter animal is gonna take about 70% of your income over your lifetime. So we're gonna give you a strategy to move this to zero, so that really you're gonna keep your money and not the federal government or state government or any of those governments. And in order to do this, we have to really think differently, because most of the conventional wisdom that we've heard throughout the years is, quite frankly, wrong. It benefits one party, and usually it's not us. So what y'all are going to hear about today is the eQRP. And it's a unique type of qualified plan. It's actually the enhanced qualified plan, qualified retirement plan. It's something that only my company provides, and it's because we created a hybrid in the retirement space that gives you all the options and liability protection, and it really gives you a way to invest with all the benefits without any of the downside. And if you want to sum it up, it's the 401k, the Ferrari of 401ks. And then there's the next question people have, and you're probably going, well, why haven't I heard of this? And it's primarily because Leonardo DiCaprio kept you in the dark. I use him because really Wall Street doesn't want you to know about this stuff. It allows you to control your money, and it allows you to put it in things like the real estate, which is a far better choice in most cases than mutual funds or these paper products. And the biggest advantage that you have by knowing about this is that most of the money in the United States, most people's cash, your cash, other people's cash, is tied up in retirement accounts. Almost $30 trillion is in these things. And in most cases, there's an ability to move it into an account like an eQRP, where you can actually have control. And to explain what the eQRP is, it's a checkbook for your retirement money. It's where you can invest your money in anything, just about, very quickly. There's no investment fees. It's protected from lawsuits. You even have a $50,000 credit line, so you could write yourself a check next time you wanted to buy a car. Instead of applying for the bank or begging Bank of America, you could literally write yourself that check and finance yourself. And then if you want to do real estate, which I personally love it for that, because you can use leverage, you can use debt. And that's one of the things that I'm going to get into that's a very big problem, and it's a ticking time bomb with IRAs. So we don't have that problem here. A couple other options you have with investing that are very pretty common these days. Any type of syndication in real estate, whether it's domestic or global, you could be the bank. I think it's better to be the bank where you're getting paid interest than paying the bank. That's just personal opinion. I think most people would probably agree. You can buy physical gold and keep it. No other option is available like that with IRAs or retirement accounts where you can use pre-tax dollars, buy gold, and then physically keep it on you. I mean, that's a pretty amazing thing to be able to do. And if you think about it, and you can do things like Bitcoin. Anybody that's interested in the money system and where it's going, we're going into a digital space where paper and things like that are going away. And you can use this type of retirement account to invest in those or speculate if you'd like. So one of the biggest things people want to know, and it's probably should be the biggest question, is what's the difference between an IRA and an eQRP? Because that's most of the money that's in retirement accounts that's in a self-directed, like in alternative assets, is in self-directed IRAs. The differences, the primary differences are IRAs are very, very slow. They get taxed when you have real estate with debt. You can only put like $6,000 a year in them, and you can't do a Roth IRA if you make too much money. And whether or not that applies to you, eventually it probably will apply to you, and you don't want to get exempted out where you can't use it. eQRP is literally 10 times as much money you can put in. A Roth is available for everybody. You can use as much debt as you want and not get taxed, and it's wicked fast. So I think one of the things that's happening right now is, there's probably a lot of conversation in this group about this, is the syndications and putting deals together and participating in the deals. So I'm going to give you an example of a syndication, and we're going to kind of go through what it would look like if you use different options. So for example, if we do a syndication that has a $5 million purchase and there's $1 million in cash with $4 million in debt, that thing it's kind of a common type of building that people are buying and putting stuff together. And then the idea is we take that building and over maybe 5 years produces some cash flow, and then it's sold for say $7 million. Very common. These are pretty realistic numbers. So that means there's like $2.5 million worth of profit. So all is good until you run into the tax problem because people used an IRA and nobody told them not to. So here's what it looks like. You've got $7 million in sale, all that profit, but then there's this thing called UDFI, and I'll get into what that is. Basically, there's this crazy tax that the IRS has imposed on people that use IRAs for real estate. And the cool thing is there's a way out of it. It's called the eQRP, which is what we do. And it's exempt. So literally no tax. So the same investment, and instead of $560,000 in tax, it's zero. The UBIT it's called unrelated business income tax, and it's derived from unrelated debt financed income. So basically anything that has leverage, if there's a loan involved, then the IRS says, well, that's not just the retirement money, that's also this other thing that's participating, so we're not going to let you keep all the money. And so you end up losing a lot of the profit. Here's what happens if you shift it. If you shift that account from an IRA into an eQRP, it's a different part of the tax code, and it's exempt, so the whole $2.5 million gets to stay in your account as the investor. And sadly, those that are still in an IRA are writing a check for $500,000, which sucks. It's a terrible thing, and it's not necessary. And we're back to zero. So that's that zero number we like. We're going to zero, and we're paying zero taxes, and we keep our money and keep it rolling and use it for our own families. Here's an example of one of our clients that came to us, and they said, we just bought a house a number of months ago, did a rehab on it. We sold it for $300,000, or we're in contract to sell it for $300,000. Here's the profit. Net profit's $58,000. I said, okay, well, what's the problem? They said, it's in our IRA. And I said, well, that is a problem. You're going to pay out of that $58,000. You're going to have a big tax bill. And they said, all right, well, how do we fix this? Because they were going to have to write a $20,000 check. And instead of doing that, we just said, all right, well, let's move this house from your IRA into the eQRP. And when that happened, they went to zero. They got to keep the whole $58,000. And this was literally weeks before they were closing on the deal. So it's a cool thing to know that you can actually fix a problem even if you've already invested with an IRA. And it's called an in-kind rollover. So I'm actually jumping ahead my stuff a little bit, but we want to get everything we can into an eQRP because it's exempt from that UDFI, the unrelated debt financed income event. And I jumped into this already, but basically, if you've already invested in a deal, like you've already got your money in a syndication, then we move it. We move it from the self-directed IRA into the eQRP, and then there's no UBIT. So the question is, all right, I want to do this, but am I qualified? And let me tell you who's qualified. Let me take a look and see who. There's a question here. Christine, if you want to just clarify your question, I'm not quite sure what you're asking, but I'm happy to answer it. And then who's qualified? So you kind of see who's qualified. If you're syndicating deals, if you're putting together deals, if you're a property manager of deals, if you're self-employed, if you're investing, if you've got any type of business activity, if you're a W-2 employee, and all that means is you have to have some other type of business, some side hustle. You could have an eBay store, a lemonade stand. You could have an online portal where you can make money selling something. It's almost impossible to not be qualified if you want to do this. And even if you have employees, you can do it. We can set up a plan to where you could utilize this and invest in real estate. So people like your relatives, your kids, even grandma, like anybody can do this. And one of the things that I did years ago was I set up a plan for my dad before he passed away. And it was a Roth plan. So when he passed away, I inherited it. And if you set that up either for yourself and somebody else inherits it, or you have family members and then you inherit a Roth account, then you get to grow that thing the rest of your life and spend it the rest of your life tax-free. So this is a really powerful way to set up legacy tax planning with a family. And it's a great conversation to have with people. Not that you're wishing anybody dies, but we all know everybody dies. So it's a really powerful way to keep more money in your family instead of handing it off to the folks in DC. Here's kind of a fun thing. In the actual presentation, there's a picture of me as a child in this lens, and it's because I was a child model. And it's one of the things you can do is if you have kids, you can hire your kids. You can pay them up to $12,000 a year. They don't pay income taxes on it, but you get a write-off. So you pay them for things. They could be doing, stuff on social media. They could be modeling. What else do you do with a 4-year-old? And they kind of have to be a model. So you can do a lot of things. And basically, this is whether you use this for a retirement account or not, it's a way to reduce your taxable income and shift some of that money, because your kids are going to cost money anyway. So this is a great way to shift money over, and they could contribute, if they wanted to, that entire $12,000 into an eQRP. So it allows you to kind of redirect some money and move it around. And for most people, if you save $12,000 in income, that's probably at least a couple $1,000 in tax savings instantly, maybe even 3 or 4. Let's see, the getting money into the eQRP, pretty much anything, any type of retirement account you have, IRAs, 401ks, thrift savings plan if you're a federal government employee, public employees, firefighters, teachers, police officers, all of that stuff can be rolled over. And there's an unlimited number of them. If you have 5 different previous employers, you can roll that over. And the only thing you can't really roll over is a Roth IRA or an inherited IRA. Those are 2 things that can't be rolled over. And it's iffy if you still work somewhere, whether or not you can roll that stuff over until you actually leave. When you leave, you can 100% roll it. And it's a case by case while you're still working somewhere. And then in addition to that, you can put up to $56,000 a year into a plan. When I talked about the IRAs, you can only do $6,000. Or if you're over 50, you can do 7, which, do that for a number of years and you're not going to really have any money. You're just going to get older. So those are the big differences. It can be deferred or Roth. So it can be pre-tax or post-tax. And there's no income limit. So no matter how much money you make, you can make contributions. Let's see. Question from Kevin. Is this limited to IRAs only, or can one use 401ks funds as well? You can put any type of money, any type of retirement account or money into an eQRP. It can be IRAs, or you can use 401ks to put in here. I think that answers the question, but if not, just clarify and I'll dig into it a little bit more. All right. Let's see. I think I mentioned so this is the credit line, and this is sort of a funny story because when I had a big event in 2008, like a lot of people, and lost a lot of money, and my American Express got turned off because I was in the wrong industry. And I went to buy this pile of toilet paper, and they said, no, sorry, your card's declined. And that was a huge bummer because American Express Black cards are supposed to have unlimited borrowing ability. And what I would have liked to have known that I didn't know back then was that retirement accounts, the eQRPs have a $50,000 line of credit built in. So I could have actually bought my toilet paper if I'd had this account set up. But instead, I couldn't buy my Costco pallet of toilet paper. So anyways, that's a really cool thing. It's not available with IRAs. It's only available with eQRP. Question, yes, can you talk about the risks? You have control of your money with an eQRP. So for some people, that's a bad idea. Having control of your money is not something that you should, not talking about people that are spending their evening learning. That's generally a pretty responsible crowd. But there are a lot of people that probably shouldn't have control of their money. They really need somebody telling them what they can and can't do and what they should and shouldn't do, and really just not giving them access to it. You're going to have a checkbook with your money. So if you want to be reckless, there's nobody stopping you. That is a huge risk for somebody that's crazy. That's the biggest risk. I mean, quite candidly, it's not really that hard to manage it, because if you can balance a checkbook, you can balance an eQRP. You just have to keep track of what you're doing, and it's not super challenging. Tax consequences. There are no tax consequences. There are no taxes. There are no penalties. There's nothing. When you roll over funds from a 401k or an IRA into an eQRP, it's not a taxable event. So you can do it as many times as you want, as much as you want. It's not tricky because you're not distributing. The taxable event is when you distribute money. So the question, 56,000. 56,000, is it deferred or is it not? It's up to you. So if you want to have a tax deduction this year on up to the whole 56,000, you can do that. You can have it all post-tax, so it's all Roth, and then it never gets taxed again. You could do part of it. And then it just depends on when you want to pay tax. So it's really up to you. You've got a lot of flexibility, and it can go either way. Let's see. What other questions do y'all have? I mean, that was kind of the speed round of the eQRP and giving you the big pieces of it.
Hey, Damion, I think there are a few more questions in the chat window, the Q&A window, sorry.
Oh, okay. Let's see if we can find the Q&A window. Let's see if I can find that on one of my screens.
Okay, I can tell you what it is. Yeah. One question is, how much does it cost to set up?
So it depends on whether you are by yourself or whether you have employees. It gets more complex when you have employees, and we set that up. If not, it's about $3,000 to set everything up and includes your first year. So it's a flat fee and a flat annual. There's no transaction costs or assets under management, which is really where Wall Street and custodians make a lot of money. We just don't do that kind of thing.
And the flat annual fee is?
Flat is $399 a year.
Okay.
So that, what other questions were there? Or was
I think the other one I cut and paste is 56K tax deferred. You answered that question already. Okay,
good. I'm happy to answer other questions too. And if you want to have basically a Cliff Notes version of what the eQRP is, you can send a text message to the phone number 72000 with the word QRP, and it'll send you the report. And then if you want to copy the book, it'll give you an option for that, and I'll mail it out to you. It's on me. So if that's helpful, happy again to answer other questions and anything that you guys have that might be on your minds, whether or not this is QRP related or not. I can talk about whatever y'all want to talk about. Let's see, another question. Mother owns a retail store. If she includes me as a co-owner, would I qualify as self-employed? Okay, good question. So if you are a partner in a business, and if you're a partner or you're an employee, basically if you're inside that business, you're going to qualify. The question is, how do you get money into the account? So basically, if you have other money that you want to roll over, then we could have a plan and you could roll the money over. If you wanted to contribute new money, you'd have to be paid as part of the business that you owned. So if you have a W-2, this is kind of the essence of it. If you have a W-2, the W-2 income is not going to be able to be moved into an eQRP. If you want to put new money in, then you have to have some type of self-employment or own a business that you're going to contribute from. Hopefully that answered that. And the 56,000 annual limit. So that's also under age 50. So if you're under age 50, 56,000 is the max, and it's based on your income. So there's two pieces of it. There's an elective deferral, which is like what you would contribute to at a 401k at work. That's up to $19,000 a year. And so if you make $19,000 in income, you could contribute the whole thing. And then there's another piece of it, which is called the profit sharing, and that's up to 37,000, and that's a percentage of your wages, whatever you're paying yourself or whatever you're making if you're self-employed, like your 1099 income. So as an example, if you made $100,000, either self-employed or your business, you made $100,000, you'd be able to contribute about $36,000. So just kind of give you an idea, it is a formula.
So, Damion, I have a quick question. If I roll my, let's say, an employer 401k into an SDIRA, and I've been using that for investments, can I roll that into QRP?
Yeah, so you can roll anything into the eQRP except for a Roth IRA or an inherited IRA. Anything else you could roll in, whether you've rolled it before, whatever form it's in, whether it's a SEP or a self-directed IRA, anything can be rolled over.
Got it. I think there are a few more questions.
All right, let's see what we've got. If you have a 401k at work you can't use until you leave, then usually employers don't let you move the stuff over until you leave. It's called an in-service rollover, and it's legally allowed, but a lot of times employers don't want you to do it. So you just have to ask the administrator of the plan if that's an option, and if they say yes, then a portion of your funds are going to be able to be moved over, and you could still stay at the job and move them over. You just have to ask the question, because we never know. It's totally like, 1 in 10 says yes, and most of them say no.
And question on that further, is there, I've heard that you can do a Quadro out of the plan in Texas and California. If you have a spouse and they can request a Quadro out of the plan. What are your thoughts on that?
Yeah, we've seen clients do that in Texas pretty frequently. So some of these more complex things with qualified domestic relation orders, those type of things, you really need to look at the case where you live. But I've definitely seen clients do it, so it's an option.
Okay.
Question is, the funds contributed to the eQRP must derive from your business, either your business and if you think of yourself, like I think Jay-Z said this, he's not a businessman, he's a businessman. Like, he is a business, and we all are a business. So basically, the reason I'm saying that, not just because I like Jay-Z or something, it's just because the funds contributed must be from your business, and your business can be you, or it could be, it could be a taco stand, or it could be whatever. And so it has to be something that you control, you own, your self-employment or your business. And then it couldn't be from your W-2 from a company that you work for. Like that's the one thing that you can't use money from. And let's see. All right, good question. What is the advantage of an eQRP over a Roth IRA? So the eQRP has both deferred and Roth. So it has both pieces. The big difference between the IRA and the eQRP is that an IRA gets taxed if you use if you invest in real estate that's leveraged, meaning it has debt. And pretty much all real estate, that's why we like it, has debt. That's a huge advantage. An eQRP, you're going to control, you've got a checkbook. An IRA, there's a custodian. It tends to take, I've seen many, many times people are doing investments, or they want to do an investment, and the custodian takes 2 or 3 weeks to get the deal done, meaning they have to get the paperwork and approve it, and people lose the deal. There's no delay because you've got a checkbook. So you can invest in 5 minutes if you want with an eQRP. So those are probably the two most relevant differences. So, there's different things you can do. Like, you can buy physical gold and hold it in an eQRP. Can't do that with an IRA, no matter what it is. And that's actually not what a lot of IRA people are saying. Unfortunately, they're not following the IRS code. So huge advantage. You've got the control. Comes down to control and speed. And let's see what else. Okay, so question, do you have to be self-employed or own a business in order to roll over? You have to have some type of business something. So like I said, you could have a lemonade stand, you could have an online store, you could consult, you could be a roving notary. And I mean, you could do one notary a year. There is no limit. The IRS does not say you have to have $100,000 in income. They say you have to have a business, and a business literally can be anything. I mean, I've had eBay stores that I lost a ton of money on. It was still a business. So you just have to have something, and that's all it takes to be able to roll over an IRA into an eQRP.
So, Damion, do you also guide people who come to you on setting up a eQRP and what kind of business they can possibly open? Or
yeah, absolutely. I can give you a whole list, and you can pick, because there's a ton of options. A lot of people have online businesses, which is very common, very, very simple to do, and totally qualified. So that's probably the easiest thing. I mean, literally, if you have an eBay store and you start selling something on there, you're covered. It's very black and white. A business is a business because it has the potential to make money.
Gotcha.
It's pretty simple. Will you be able to help set up an LLC to invest in the QRP? I have a single member LLC. Yeah, we help with the entities. We help whatever structures we need to work with or set up. We do all that stuff. Can the rollover amount be? Okay, good question here as well. You can roll over as much as you want. So the rollovers are unlimited. The 56,000 is just how much you can contribute from what you've earned, like in your earnings. If you want to contribute, that's totally different numbers. So you can do whatever you want. If you have $500,000, you could roll it all over. Roth. So Roth is after-tax money. Just to explain what Roth means, it basically means that you're going to pay taxes now, and then as it grows, you're not paying taxes. And when you pull the money out, you're not paying taxes. That is an unbelievable opportunity that I don't think will last forever. I think it eventually will be removed because it's one of the smartest things that you can do is take yourself out of the tax code, because tax rates are going to get higher down the road. There's just no doubt about it. And this allows you to pay whatever taxes you need to pay now and then let that thing grow, and you get to spend it down the road tax-free.
I have a follow-up question on the Roth, Damion. Can you convert some portion of it to the Roth as much as you want?
Yeah, great question. That is one of the amazing options. If you've got money in an IRA or a 401k that's going to be part of your eQRP and it's pre-tax, meaning you haven't paid tax yet, you can convert it as much as you want, all of it if you want, to Roth, and then you pay taxes on the amount that's converted. And it basically, if you converted 100,000, then you would add 100,000 to your income whenever you did it. So if you did it today, then in 2020, when you pay your taxes, you're gonna add that money on. So you have that. You can't do that with an IRA because there's income limits. And if you add a whole bunch of money in conversion, your income goes up a lot. So you've got unlimited options to do that now.
And can I offset that with depreciation? Is that considered passive income or active income?
Depends on whether if you're a real estate professional, you can offset the entire amount with depreciation. So if you're going to do this strategy, which we call this the golden strategy, all the top CPAs in the country and it's basically the golden strategy. If you're going to convert, when you convert, make sure you're a real estate professional, and the strategy is go buy some real estate or invest where you're getting depreciation and use it to offset the entire conversion. Now you're not paying taxes ever. That should make your head explode. That is the coolest thing that exists in the tax code right now, in my opinion.
And I think there was another question now in the chat window is if it needs a business, how is it different from a solo 401k?
So solo 401ks are set up for individuals. They can't take on employees. They don't have liability protection built into them. They're basically a cookie cutter type of trust, and they are exempt from UDFI. So there's no tax, but they blow up if you have employees. And if you get sued, which it's like the United States of lawsuit here in this country, unfortunately, it's up to the courts on how much they can take of that and give it to somebody else, because individual plans like a solo 401k are not subject to ERISA, which ERISA is it's the legislation that was passed in the early 70s that created 401ks and IRAs. That is really protective of 401ks and the money that's in those if it's a group plan. A solo 401k is not a group plan. It's an individual plan, and it's not protected by ERISA. So huge difference. They're totally written differently. So that's that's why a solo 401k is cheaper too, because it's a cookie cutter generic trust. All right. Who else has a question?
I think there was a further question from Lance. Let me further ask about the retail store my mom owns.
Yeah.
I could see, can you see it?
Yeah. All right. Let's see. There's a store listed as a co-owner and investing with my traditional IRA, which is in a multifamily apartment. Could I set up the eQRP and do the in-kind rollover from my existing traditional IRA in the apartment complex? The answer is yes. So basically what we're talking about is an IRA that's already invested in real estate and is subject to the UBIT tax, which means you lose 30+% of your profits. In order to fix that, we move that asset, it's called the in-kind rollover, we move it from the IRA into an eQRP. And so because there's the option to set up an eQRP and the eligibility, we can fix this and take the tax down to zero and make it exempt. All right, who else? Or any clarifying questions on this stuff? Do eQRPs get audited? I'm not aware of anything that doesn't get audited, whether it's people, companies, retirement plans. Here's the thing about audits in general, and I'm not an accountant or an attorney. I have a lot of them, and I pay them a lot of money. I can tell you that people with a lot of money tend to get audited more, because if the IRS, with their limited resources, is going to go after and audit somebody, they're going to want to try to recover something. They don't audit you if you made $15. It's because they have limited resources. So, for example, Mitt Romney has 100 million plus in his Roth account. He's, in my thinking is the IRS is more likely to audit him. And our current president says he's under audit. I think he's been under audit for the last 3 or 4 decades. It's because when there's hundreds of millions of dollars, that's where the resources are going to be, because that's where they're going to recover money. So could it get audited? Of course. Is it going to be? It's pretty unlikely. We have actually never had a client in the last decade that has been audited. So if that gives you any sense, and then we're talking about many, many thousands of plans. So it's pretty unlikely. And also, this is why you have CPAs, because they make sure that if you do get audited, they take care of it, and they go and they deal with the IRS. Let's see. Okay, other questions? Justin's answering some. Okay, any other questions? And you guys, if you have any questions, you can always follow up, and we're happy to help. And I think there's probably if you want a copy of the physical book, if you can either text the number to get the Cliff Notes. If you want a copy of the physical book, it's eqrpbook.com. And we'll send you a copy of it. And then if you have follow-up questions down the road, because there's a lot of information here, we can answer that. And just visit us at totalcontrolfinancial.com, and we can help you guys any way you want. Or if you have current stuff, or whether or not you want to do this, I'm always happy to answer retirement questions or real estate questions, support you guys any way I can.
Okay. I think there are no more questions. Thank you so much, Damion, for your time today and for talking to us about eQRP. If there are any questions coming to me, I'll direct them to you, and also put folks in touch with you if they have any other, if they're interested in the book. Thanks, Justin, for sharing the eQRP book, which is eqrpbook.com. I appreciate both of you and all of the guests here today for joining our call, and hope this was useful, and we'll stay in touch, and we'll do more webinars in the future. Thank you so much for joining. Have a good evening, everyone.
Thank you.